Hey everyone, and thanks for jumping back into the Equityverse. Today, we're going to talk about the SP 500 bear market, and we're going to go through systematically and compare it to bear markets of the past. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. We do have several different tiers that you can try out. Make sure you check that out in the description below. Let's go ahead and jump in. So this bear market by the S&P 500 throughout 2022 and of course early 2023 has been a fairly slow and systematic downtrend. We've often described it as a structural bear market. Now, the first thing I should say is when you take a look at the 2022 to 2023 bear market, this is assuming that it actually puts in a new low. If it doesn't put in a new low, then it's just the 2022 bear market. For the time being, though, I will continue to assume that there's a high likelihood, unfortunately, that the S&P will be putting in a new low this year, and therefore I will continue to reference it as the 2022 to 2023 bear market. Now, you might wonder why am I of the opinion that it will put in a new low, and maybe we'll talk a little bit about that later on in the video. But the first thing I want to do is to go through and make the same systematic comparisons that we made in the past and that have kept us on the right side of this for basically the last year. Now, if you take a look at this bear market and compare it to all of them, they're sort of all over the place, right? So what we're going to do, we're going to first just kind of take it one by one so that we can kind of understand how investors have felt before us, what potential outcomes did they see, and that way you could probably use that information to better navigate the current financial conditions. If you take a look at the most recent bear market before this one, it was the one in 2020, but it's not really a great example, mainly because it was a very short and sweet bear market and the Federal Reserve printed our way out fairly quickly. Unfortunately, they're not going to do that this time because inflation is quite high. And so I don't really think this bear market is a good one to compare to. If you take a look at the financial crisis from 2007 to 2009, you will notice there are a lot of similarities. And you might be led to believe that it has to break down the exact same way. I would argue that's not actually true. It's always a possibility that we could see the entire market break down. But I do think in order for the market to break down like it did during the financial crisis, we would need to see something pretty major break. And that hasn't happened yet. It's not to say that it can't happen, but I don't know if assuming such a major downturn within the next month or 2 months would be, the most likely outcome, although it is certainly an outcome that is worth considering. Oftentimes, I've said I would actually prefer to just rip the Band-Aid off rather than have a slow bleed for a couple of years. If you think about what happened during the financial crisis, while it would have been quite brutal for investors of that time, especially the ones that just kept buying the dip all the way down, if you take it out till the next peak, it sort of makes this whole area over here somewhat irrelevant, right? Now, it's not really irrelevant to the people that stacked cash along the way over here and had the money to buy at the depths of the recession over here did much better because, frankly, they were able to get about a 50% discount from the most recent all-time high, and then the market exploded to the upside over the next decade. But again, you take a look at the current bear market, you overlay it with the financial crisis, we have to at least be cognizant of that potential outcome. But again, the counter argument is if you were to overlay any type of prior downtrend in the S&P 500, it might look somewhat similar to the one we're currently experiencing. For instance, this is a financial crisis compared to the current bear market, but just to give you a way, or at least to show you how our eyes could easily deceive us, if you were to go take a look at the 1946 to 1949 bear market, you could say it also looks somewhat similar. And there really never was a huge breakdown to the downside. This was also coming out of a period of high inflation because of the Second World War. So I would argue it's not worthwhile to spend too much time assuming that the current bear market has to follow any specific analog of bear markets of the past, though it is a reason for us to be on our toes. Another example that I think is worthwhile to look at beyond the financial crisis is the dot-com crash. And the reason for this is because we know the dot-com crash, there were some similarities between what was going on back then and, of course, what happened recently in 2020 and 2021, right? There was a ton of meme type stocks, cryptocurrencies, etc., that were just sort of blasting up like crazy, where they really had no business doing so. And of course, it was also a fairly structural bear market where there wasn't a major break to the downside that ended the bear market. It was just a slow and steady bear market with slightly lower highs and slightly lower lows for over 900 days. Now, this almost lasted 3 years. And I mean, that's a long time. It's not to say that it has to play out this long, but it does show you just how brutal bear markets can be, right? And if this bear market only lasts a year, that doesn't mean that the next one won't last 2. Or if this bear market lasts 2 years or longer, perhaps the bear market that comes after it might only last 6 months or something, right? As investors, we have to recognize that we're going to go through our fair share of bear markets throughout our investing career. We also must remember that bear markets do eventually provide opportunity, and they're not something that you should constantly live in fear of. Again, you can always take a lot of these out to the next peak, and it shows you just how quickly those gains can come back. I mean, quickly is somewhat relative, right? It depends on what your investment horizon is. But again, these are all important considerations to make. You could also take a look at some of the other bear markets. There's the one from 1973 to 1974. This one I think is somewhat useful in the sense that it was also in a period of high inflation. And when you have a period of high inflation, you're bound to have a more hawkish Federal Reserve, which is exactly what we have. And if you go read the Fed minutes from today, they even said no participants anticipated that it would be appropriate to begin reducing the federal funds rate target in 2023. This means the Fed, as of right now, is still expecting to keep interest rates high and elevated throughout 2023. Now remember, it takes a long time for interest rate hikes to be felt, but the problem is that the market, the S&P, doesn't typically bottom until the Fed actually cuts rates, right? Why is that? We have to think about why would that be? Normally, it takes something breaking somewhere for the Fed to cut. And by the time they cut, the market doesn't care because something is already broken. So then the market continues to go down for a little while after the Fed cuts, right? And then the market recovers when everyone's basically given up, okay? But as of right now, you know, the people on the FOMC committee, they're basically saying we're not going to be cutting rates in 2023. So, which is, again, they've advertised this a long time, so it shouldn't really come as a huge surprise. But this is something that we have to ultimately keep in mind. It doesn't mean that we're not going to have rallies and stuff. We've had plenty of those. No shortage of bear market rallies this year. We're in 2022, and we'll probably have some in 2023. But it doesn't mean that it's over. It doesn't mean that there still isn't a potential recession coming, and it doesn't mean there's not going to be an implication on the stock market because of that recession. Another bear market that we might find it worthwhile to compare to would be things like, you know, the one from 1937 to 1942. And you can see that in that one, we found a bottom within the first year or so that held for a long time, except for a slightly lower low later on. So again, you know, these bear markets, they might always seem obvious, right? Like it might always seem like, well, it has to go down a certain amount. But not all bear markets are like that, right? Some bear markets go down and then they kind of sweep the bottom for the next 2 or 3 years before going back up. And it doesn't mean they have to have a huge capitulation, but if the Fed breaks something, then we could. I would put forth the idea, again, that I don't really want to see people in pain, but at the same time, ripping the Band-Aid off like the financial crisis would actually be probably a better outcome for investors in the short term, because if you rip the Band-Aid off, then you can more quickly find the bottom and then trend up from there. And if you take both of these and take them up to the next peak, you know, over here during the 1946 to 1949 bear market, we continue to sweep the lows for years. Whereas the financial crisis, where something broke, we found a bottom a lot quicker, and then we just trended up from there. And it's a lot more fun to just get into a market where you're slowly trending up. The actual value of the bottom is somewhat irrelevant, right? It's just a number that hopefully you got a position at somewhere near that value so that you could continue to ride the uptrend. If it goes sideways for 2 to 3 years, it can really wear people out and make people throw in the towel. So these are all important considerations. Now, if you go take a look at the S&P 500 right now, we have talked about the idea of the base case here just simply being continued rejections off of the downtrend line. Now, I'm of the general opinion that at some point the S&P will, of course, break this downtrend line. Now, this is not a crazy opinion to take. I mean, eventually all trends are going to be broken. But my point is that whenever it does break, it doesn't even mean the bear market is over. If you assume that the bear market's over, once the trend line breaks, you might fall for a similar type idea or a similar thing that people fell for back over here, right? Where there was also a somewhat similar trend line where we had, rejections off the top of the trend line. And eventually we broke above it, but it was a fake out and it ended up being a double top with a prior rejection off the trend line. And then we had the final move into the major bottom, right? So I do think it's worthwhile to consider that as well, because you never know if something like that could play out again where you do see another pop back above the trend line, but perhaps it doesn't actually mean anything. It doesn't mean it has to play out right now. I mean, back over in the other example that happened like another 6-10 months from now, like it would have been like the end of this year, I think, if you were to make the comparison. But that's also something worthwhile to consider. The other thing I was looking at is note that if you have the bull market support band, the bear market resistance band, whatever you want to call it, every single time we've had a rejection by it, we kind of come back down, we go back up to it, and the first time we go back up to it, we get rejected. And then we go put in a new low, right? It happened here. And then over here, we came down below it, not nearly as far, but then we came back up to it, got rejected, and then came down and put in a new low. And then again, rejection up here, go below the bull market support band, come back up, get rejected, and then go down and put a new low. Same thing, right? Top, double top on the trend line, coming back up right here up to the bear market resistance band, if you prefer to call it that, as opposed to the bull market support band. And, if we get rejected again, then I think that the base case would just simply be that we're likely going to go put in a new low. If we bounce back above it and come back up here, I would still contend it's likely we will eventually roll back over and head back the other way. It just might be delayed by a month or two. But this is my general expectation of the S&P 500 right now. I do remain very cautious on this, at least for the duration of at least part of this year, I should say. If you have been stacking cash throughout 2022, I think you can look back at 2022 and be happy that that was your strategy. But of course, at some point, you'll have to flip that strategy and go with a new one. But so far, it does seem like it has worked out fairly well. So this is where the S&P 500 is right now. Now, to go back to the original thing is like, well, why does the bear market have to continue? Well, first of all, it doesn't, right? Nothing has to happen. There is always a scenario, right? I mean, no matter what the probability is, right? There's always a scenario where the bear market ends and we go into a new bull run just when people are least expecting it. But I will say there is still evidence to suggest that the bear market is not yet over. Some of that evidence would include things like the yield curve and the inversion of the yield curve. And we've talked about this quite a bit. If you go take a look at the yield curve, you can see that it's actually quite inverted. And if you go look at prior recessions, before prior recessions, we also saw similar types of inversions, right? And this is an important thing to consider when you're trying to figure out if the bottom is in or not. Normally, the stock market has not bottomed until after the recession was actually here. But the recession, at least, has not yet been officially declared. Now, you might say, well, it should have been officially declared. The counterpoint to that idea would simply to be pointing at something like the unemployment rate and say, well, it remains relatively low, right? And so how could the recession be here if the labor market is still relatively tight? But the counterpoint to that would just be to say, well, the unemployment numbers are not accurate. And even recently, they've been revising some of the stuff from 2022, right? So I think it's probably important to consider that we will likely not get a declared recession until the unemployment rate starts to go up. And until that happens, I think it might be somewhat premature to spend too much time contemplating about whether the bottom is in on the S&P 500. The reason is if you look at these gray shaded regions, which is where recessions occur, normally the bottom of the S&P occurs during the recession. Now, admittedly, the recession declarations come after the recession has started, but still, the bottom has occurred while the unemployment rate is going up. And the unemployment rate has barely moved for a long time. I mean, it's been at these lows basically since 2021 or early 2022. But if you start to see this unemployment rate go up in a material way in 2023, and you start to see the Fed slow down their interest rate hikes and even cut them in, say, late 2023 or maybe early 2024, something like that. Again, right now, the committee members are saying they will likely not be reducing the Fed funds rate in 2023. I don't think they're going to reduce them, at least for the first half. But, by the end of the year, it's hard to say. It's hard to know exactly how long the market will hold up and how long the economy will hold up as long as they're raising interest rates and keeping them elevated. So they might be forced to pivot by the end of the year. But we have to live with the idea that it might take until 2024 to see any type of a pivot to the Fed going back to quantitative easing. And you might say, well, why? Why is that? And why do they have to remain so hawkish when it seems like the world is falling apart? Like, it seems like the markets are crumbling, and it seems like our if you have like large investments portfolios, it seems like they might be down a lot, and then therefore you might equate that to the economy doing poorly overall. But on the contrary, the stock market is not the economy. And the economy, by the time, assuming the bottom's not in on the S&P 500, by the time it is in, the economy is probably going to look pretty bad. And the bottom for the S&P could be in while the economy still looks pretty bad, right? And so we have to remember that nuance, that the stock market and the economy are not the same thing, right? Labor market still remains relatively tight. It's just a fact. Now, there have been some tech layoffs, but the service sector arguably still remains quite strong. At least right now it does. And so as long as inflation, right, as long as inflation remains high and somewhat sticky, the Fed, I think, will be compelled to remain hawkish as long as inflation stays high. Now, here's the thing. It's sort of like a catch-22, right? Like, okay, the Fed wants to raise, theoretically, interest rates, but they don't want to cause a recession. But the issue with that is usually it takes a recession, these gray shaded regions, to actually bring inflation back down in a material way, right? It takes that economic hardship to be felt for inflation to actually come back down and for wage inflation to also come back down. Wage inflation likely isn't going to come back down quickly if the labor market remains this tight. And if unemployment is sitting below 4% and you still have inflation year over year at like 6 or 7% or something, at least headline inflation, it still is going to put some type of upward risk on potentially higher inflation later on. And see, here's the issue with what the Federal Reserve is having. It's a balancing act. Inflation is high right now, but look at what happened in the 70s and the 80s, right? Like, we had a peak and then it came back down, and then it went back up again, and then it came back down, and then it went back up a third time. Powell has referenced this many times as not wanting to make the same mistakes of the past. If they switch prematurely to looser monetary conditions before inflation is back down at their target of 2%, then they run the risk of inflation just coming right back and going into a period of relatively stagnant stock market returns. This lasted for 10 to 15 years, right? And I don't say that lightly. I mean, it lasted 10 to 15 years. So my preference would be that the Fed remain hawkish to bring inflation down in a material way, understanding that they probably will go too far. They probably will. And I don't want to see people lose their jobs. The counter, though, is what happens if we just go into a period where inflation is sitting at 7, 8, 9, 10% for 10 years. Like, that's going to be also very bad for people. And that could happen if the Fed flip-flops between QE and QT every couple years, right? So if they do something like that, they're going to be making the same mistakes of a generation or two before us, where you get a decade-long period of high inflation. And Powell has said as much. They want to just get inflation back down to 2% so that we can go back into another cycle of economic expansion. That's what I want, right? I just want to go back into another phase of economic expansion. But again, right now, inflation remains high, the Federal Reserve remains hawkish, and the S&P 500, until proven otherwise, remains in a bear market. Now, what would proven otherwise mean, right? Like if we were to have some type of a, sort of like an invalidation criteria, is it enough to come back up and break the trend line? No, I think you can break the trend line and it still be a bear market. We might be entering into the final stage of the bear market. Like again, if you go look at 2000, after we broke through that downtrend line and had sort of that double top where the first top was at the trend line and the second one was above it, the next capitulation was basically it. I mean, we had sort of like a bottom and then a double bottom and then maybe even a triple bottom. And then we were sort of back off to the upside. But it took breaking that trend line. So I would say breaking the trend line is not enough to sort of unilaterally declare that the bear market is over. I think you'd have to see some type of a pattern where you come up, maybe you put in a higher high, and then you come back down and put in a higher low, and then start to build off that, right? So if something like that happens, that would probably be the invalidation criteria to say, all right, well, perhaps the bear market doesn't have to go on as long. But if that doesn't happen, which is not my base case is that the bear market will continue, then we have to be prepared for further downside. So remember, every single time that we came below the bear market resistance band, we popped back up to it only to get rejected. And so that's where we currently are right now. So it ranges right now, if we were to get you the exact number so you could be watching it. For the S&P, it ranges from 3861 to 3909. So pretty important line in the sand to keep an eye on, around that 3900 level or so. Now, the one thing that sort of has me kind of questioning the short-term moves, which again I would argue are like a random walk or geometric Brownian motion. I see all sorts of people try to predict short-term moves on a daily basis. They'll call things what they think's going to happen. It's hit or miss, right? Like no one has a really great track record at short-term moves. They're all over the place, especially in bear markets. In bull markets, people just say it's going to go up, and it usually does. But in bear markets, it's really hard to predict because it might seem like it should always go down, but there's a lot of days where it goes up. And then there's there's a few days where it goes down quite a bit and wrecks everyone who was riding a bear market rally. But there are some recent wicks here on the weekly time frame, so there are at least some bulls saying that they're not going down without a fight. You can see that, right, with all of these wicks on these weekly candles. They're saying, hey, maybe we go down, but we're gonna at least put up one hell of a fight first. So I would still keep an eye on that. But again, so far, still fairly structural bear market. Some things to look out for, of course, are we do have, another FOMC meeting on February 1st. So we're going to be getting another interest rate hike. You can see markets are currently expecting a 25 basis point rate hike with about a 69% probability, 31% chance of a 50 basis point rate hike. If it ends up being 25, then you're essentially looking at 4.75 for the Fed funds rate. Regardless, market participants think that by March, the Fed funds rate will be at 5%. And furthermore, by June, market participants think it'll either be at 5 or 5.25%, which I think makes a decent amount of sense. I would probably say it's more likely, like we should be at 5% by March is my guess, right? Like if not February, we could be at 5% by February. But if we're not at 5 by February, I do think we will be there by March. And then at some point, my guess is in Q2, Q3 at the latest, but I would guess Q2. I think the Fed will stop raising rates. So I would say probably going to happen in Q2 or Q3. They'll stop raising rates, and then they're going to hold them there. And they're going to wait and see what happens. And if inflation starts to go back up again because monetary policy has not been put into a restrictive enough area, then you could see inflation. I mean, if inflation were to come back, you could see the Fed have to raise rates again, even after they pause, right? Which is probably not a case that a lot of people have considered. It's not one I've spent a lot of time considering myself, but it might be something we have to consider. I think a lot of us just assume that if the Fed gets to 5% and they hold it there, it's going to kill the economy and inflation is going to come back down. And that's probably what my base case is, but we should be at least aware that there's a chance that the economy is more resilient than we think. So anyways, hopefully this makes sense. I hope that this tour of not only the stock market and the bear market structure that we're in, and of course through the macroverse, has at least been somewhat useful in you navigating these financial markets. Again, remember to check out Into the Cryptoverse Premium at intothecryptoverse.com. We do have a sale going on, so make sure you check that out. And I will see you guys. And make sure you subscribe if you're not subscribed. I'll see you guys next time. Bye.